Hello everyone. Today we're going to talk about what we see in the markets after the Federal Reserve has increased slightly its interest rates. An interest rate hike that everybody was expecting, very much in consensus, but what we are seeing in any case is that the subsequent rate hikes are more doubtful. It's less likely that we see 3 hikes this year, or even 2. I don't think that there'll be more than 1 more, and it's questionable considering both economic sentiment, GDP growth, and some of the imbalances in the economy, particularly in emerging economies. But what it shows to us is that we have to continue to be exposed to the US dollar because it will likely continue to strengthen relative, particularly to the euro in my opinion, and relative to other emerging market currencies, because demand for dollar is rising while supply is not increasing. And that is a very important effect, because that is exactly the opposite effect in the case of the euro, where we are seeing that demand is actually not increasing. However, supply continues to grow aggressively with the QE and the messages of Draghi that it'll continue, that the ECB will continue with its policy, even be more aggressive, actually, because inflation expectations are coming down. And this is another important factor, is that the reflation trade that has made investors pile up into emerging markets, into inflation-linked assets, is slowly dying down. And we're seeing inflation expectations coming down in the European Union, also in the US, and very important, what we are seeing is a gradual downward revision of some of the emerging markets, economies, and economic growth expectations. In Latin America, Brazil, Argentina, some of the oil-producing countries, the estimates are coming down. In Asia, we're also seeing some tweaking to estimates of growth. Therefore, we have to be very, very cautious, because while inflation expectations are coming down, while commodity prices are losing part of the exuberance that they had at the beginning of the year, and now what we're seeing is that coming back to more rational levels. While we see that those growth estimates trickle down to monetary policy, we have to be very aware of the fact that emerging markets and emerging countries are not going to be defending their currencies if we move back to oil prices and other commodity prices at levels that are lower than the support levels that were created last year. So we have to pay a lot of attention to this, because if they're not going to be defending their currencies because they want to keep as many of their reserves in foreign currency, fundamentally dollar, what we will likely see is that the capital market moves will likely move further into dollar-based assets and fear a little bit the risk of devaluation and the disinflation effect after we have seen this, the so-called base effect in inflation slowly die down. So let's pay attention to the markets right now, be more exposed to US dollar assets, be more exposed to companies in the US in which you don't have to bet on massive multiple expansion, but where you have strong support provided by buybacks and dividends. And let's continue to pay attention to growth and inflation expectations, because they look to be quite a bit at risk, not because we're going to see a risk of a recession, but because it is extremely unlikely that the factors that were required to justify the growth expectations that the market had at the beginning of the year are simply fading away. Inflation, growth of emerging markets, and improvement in capital expenditure and gross capital formation. Those elements are slowly fading away, and therefore we need to be a little more prudent with growth expectations, more prudent with inflation expectations, and more exposed to sectors in what we have is a strong support from company action in terms of buybacks and dividends. Thank you very much.